Streams. Okay, some folks are going to be trickling in any minute now. And I'm going to share screen here.
Hi, everybody. We'll get started in a minute. In the meantime, Carlos is sharing the global pool groupings. I know quite a few of you are starting to hear if you're in the finals for your country. This is one of those great sessions today that we're so excited about because regardless of how you do in EWC, today is about building your company, making sure you're ready to disrupt and create a lot of value. So we have a fantastic friend of our team who I'm sure after today you'll consider a friend too. And we'll get started in about a minute. Carlos, can you walk through just last minute reminders of Global Pool?
Yeah, sure. So for everybody that is looking at my screen right now, which I'm sharing, if you belong to any of the countries that are to the left in Global Pool, from Afghanistan down to Rwanda, anybody that is in that group, you have a couple more weeks to be able to submit your applications if you've already started it. So down below from there as well, you see that there's a place that says deliverables, evaluation through deliverables. Depending on what stage you belong to, if you are in Global Pool, you would be responsible to complete those deliverables as a part of being considered for the next stage in EWC. For example, if you're in growth stage, aside from submitting your application to the competition, you are asked to submit a pitch deck, a video of your pitch, and your OKRs, which are your objectives and key results. On the EWC Accelerate platform, you would have access to be able to submit any one of these deliverables. The same would apply for early stage and idea stage. If you see there, the requirements are laid out. There's some similarity between most of the deliverables, with the exception of idea and early asking for one extra piece of work. Again, please reference this list to make sure you are aligned, okay? And then if you are not in any of the countries that is in the Global Pool part of this slide, okay, you belong to a national competition. That means that your national organizer will be responsible for selecting who will be going through from your country. And it might be multiple individuals or startups going through. So it really depends. Every country is a little bit different. The deliverables in this case are not mandatory unless your national organizer is requesting some of this type of work. For the most part, it doesn't seem like country competitions are asking for deliverables, but look out for updates, okay? But in order to go into the country competition, you must submit your EWC application, okay? You will not be considered if you have not submitted an application, even if you have been joining us on every call. And thank you for your questions and everything else, for being so attentive and excited about the work, but you need to have those applications submitted. So last little warning here, please submit your applications.
Guys, it's been an incredible journey so far. We have over 150,000 applicants from over 194 countries at this point. And it's been so exciting to be reviewing applications and seeing all of you every week during these webinars, getting your comments on the discussion board. And it's been great interacting with so many of you. And we told you from day one, our goal with EWC Accelerates is to make sure you do well in the competition, but most importantly, your company, your team, your customers continue to do well, which means adding value. And I think today's topic really speaks so much to what our goal has been from the beginning. We find cool speakers that we trust, that we know are ethical and interesting and give new perspectives, and we give them a little bit of background, and they always come up with fantastic topics that are timely and really about helping you build great businesses for long term. So today is no exception. John Paul Milsiunas has been an amazing friend of ours for years. We've brought him in as a mentor, a speaker. We met him because he's been an angel investor and a VC for, oh my gosh, I don't want to age you, but a couple of decades now, right?
Yeah, it's 20 years.
As young as you look, 20 years. And I think the really key piece here is, even though he has kind of gone back and forth from working with early stage to corporate VC and corporate innovation, he always is about adding value and just giving people the truth, however pretty or grim the picture is. And that's one thing we really appreciate him. He's been such a fantastic mentor, not just to our startups and entrepreneurs all over the world, but me and my team trust him so much with every good, bad, and ugly thing we have going on, and knowing that he's there always with great insights, great understanding, and quite honestly, just a perspective that is about helping us be our best. And we are really, really appreciative that he found the time today to share with you his thoughts on value creation and really what he sees going on in a lot of different industries, new technologies, and how to add value every single day. So JP, thank you for being here. We are thrilled to have you. Take it away.
Okay, thank you, Susan. Thank you for that intro, and thank you, Carlos. I'm going to share my screen here, and we'll get started. Okay, do you see that all right? Okay, great. Just
we need to move your picture. Wait, JP, move the picture so that we can see the deck.
Oh, whoops.
Yeah, there we go. Now it's gone.
Okay, I see. Yeah, okay. Yeah, let me minimize that.
It's okay, we'll figure it out.
Okay, wait, let me minimize that. There we go. You see it now?
No, now we're missing the deck.
Oh, now you're missing the deck. Whoops.
I think you expanded the
1 second. I think my share stopped. Yeah.
It's okay.
Okay. Share screen. Good?
Perfect.
Okay, terrific. I'm going to talk today about disruption and value creation with a startup, and really how a startup attacks an industry incumbent and creates value for its shareholders. Just to give a quick background on myself, there's a lot on this chart. It's basically my resume, but I've had a long career of really working with early stage companies. I've also worked through large corporations, either in corporate venture capital units or in internal incubators. And so over the course of my career, I have worked across 7 leading global corporations across diverse industries. I've been a 4-time CEO, 3-time co-founder, have both raised both venture capital and private equity. I have run and been a part of 3 funds with over 100 million in total assets under management, and I've coached about 20 CEOs and founders through a variety of different transitions in their companies. I joined my first company as a startup when I was 25 years old. Actually, I had 0 CEO experience. It was just a couple of founders and a good idea, and we ended up really driving that company from almost nothing to about 17 million in recurring revenue, and sold it to Hewlett Packard for 8 times cash on cash, which was in the venture capital world, and 8 times return is almost a grand slam. I've also spent time at Yahoo, and I've looked across consumer internet companies and worked in a unit at Yahoo called Strategy Emerging Businesses, where we divested and invested in companies. And I also, through Venture Hive, actually mentored a company that was acquired by ClassPass most recently, and I've had several other companies that have been involved with the early stages. But my expertise is really around founder and CEO empathy. It's really understanding, what's important for those individuals who are leading companies at their foundational stage, and helping them to get to that next milestone so they can create value. One of the interesting things, if you think about this, and I'll just leave this up for one more second. If you do want to see my LinkedIn down there and want to hit me up on LinkedIn, I'll be happy to accept your invite. But founders are unique. They have unique cognitive biases that are important to be recognized. And when a venture investor meets with a founder, they're trying to really identify if the founder has the resolve to lead the company through a variety of different challenges that'll come up. And we'll talk about how value is created and some of those challenges that you'll see in the next few slides. So with that, I wanted to tee up something that normally gets just used in the wrong context. People talk about disruption lots of different ways, and they don't really understand how disruption actually impacts an incumbent company. A lot of people think that all of a sudden a startup came out of nowhere and disrupted this company, and now they're on the defensive side. Well, it really takes a long time. It really takes about 10 years to have an overnight success. And if you look on this chart, the old saying, you went broke gradually and then suddenly. What's happens on the gradually side, or this part under the curve here, is this is where venture capital funds a startup. And this startup is usually not profitable or losing money. And the traditional company never recognizes that this startup is coming and attacking their business until there's a collision in their strategic operating models. And when a digital operating model collides with a traditional operating model, there are huge forces at play that the customers recognize they're getting more value for less cost usually, and they quickly switch over, and the entire marketplace actually shifts in the position of the attacker. So it usually is centered around networks towards the disruptor. But not all digital firms are the same. Digital networks and AI are very important dimensions to think about in terms of strategy and competition. Understanding how to create and develop network effects are super, super important for venture capitalists to invest into your business. And JP, companies that, yes?
I'm sorry to interrupt. We have a few people who English isn't their first language. So if you can slow down a little bit, I know how fast your mind goes, but that would be super helpful. Thanks.
Sure. Okay, yeah. So the importance here, again, is to recognize how to describe your network effects or the fact that you're driving strong network effects to an investor versus having weak network effects or no network effects in what's called a pipeline business. So, in a unit sales business where you're selling an article of clothing or a widget or any kind of consumer good, you typically don't have network effects. On the other hand, where you can create network effects is where you're going to attract venture capital. And I'm going to show a couple examples of companies that do this very well. So for example, Ant Financial, Facebook, obviously Uber are three companies that have strong and profound network effects because of the platform they have created. And Ant Financial is a perfect example. Ant Financial, as compared to Bank of America, Ant Financial runs a money market fund that is the biggest in the world. Bank of America is the biggest bank in the United States. Bank of America employs 450,000 employees. Ant Financial employs 10,000. The power of a digital operating model is just that. You can have very few actual resources dedicated to the business, and the business operates on a platform business model with technology driving the business, not humans. Same with Facebook, which recently announced that they're letting all their employees work from home. The reason why is because Facebook can practically run itself. Uber is another good example of a platform that has strong network effects. Some weaker network effects, and some companies that are struggling, that will struggle here. An example is WeWork. But the point here that I'm trying to make is that these strategies of network effects and disruption apply in any industry. And I'll show you an example here in the apparel industry, where you would think that, well, what can you do to provide network effects in apparel? And how do you do this when you're just trying to sell clothing? Well, Stitch Fix is a company that's figured it out. And for any of those who have heard of Boohoo, is another company that's figured out how to provide strong network effects. On the next slide, I'm going to go into a quick example of how Stitch Fix is developed these network effects. But the point is that when you look at building a company and you're looking to disrupt an industry, apparel is a $2.5 trillion global industry. Here you have a company that didn't know the first thing about selling or designing clothes, but they knew how to create a network effect that would capture users, Stitch Fix. And this is specifically how they built their business. So there's a lot on this chart, so I'm going to go through it in a little bit of detail here. But the points are, in terms of traditional value proposition for an apparel company, you would have to walk into a store or potentially go to an e-commerce site. You'd have to shop for an item that you think you'd like. You'd then have to try on that item and figure out the sizing. And then if you didn't like it, you'd have to go through a return cycle. And you maybe have some stylists that might help you and guide you, whether that's a real person or maybe a stylist bot that might help you. Stitch Fix totally changed the game on that. What Stitch Fix decided to do was develop a survey, a style survey that would make a best guess based on an algorithm of what you may like. They then put a box into the mail to your home with items that were related to that survey. So garments and clothes and shoes and socks that you may potentially like. Well, and they offered you to return it back for free, anything you didn't like. So they learned as much from what you kept out of that box as well as from what you returned, that every subsequent box they send back to you has closer and closer items to actually your size, your fit, and your preference. And so over time, Stitch Fix is able to actually take out low margin items where they're just reselling a Ralph Lauren shirt or a Levi's pair of jeans and replace it with private labeled merchandise, which looks and feels and performs almost identical to the high margin or to the low margin product that they were reselling, but it's their own private label. So they then added, image recognition capabilities through AI, demand prediction capabilities to predict preferences, seasonality and things. They ended up building a recommendation engine for a Fix customer, and the more that you receive the goods and products from Stitch Fix, the higher the likelihood that those things are going to match your personal preference and style. And so the hard part, the work of shopping or deciding if you like this or if you like something else, or even going to a personal stylist, they put into an algorithm. And they did that with a combination of a human stylist, artificial intelligence, and a big group of data scientists. But their vision was become the Netflix of apparel. So when you go to Netflix built the first recommender system for showing you what movie you might want. Stitch Fix has built that for apparel. So when you go pick up a Stitch Fix box, it's likely to contain items that you're going to want to keep. And their business is doing fairly well, even with what's happened lately with Corona. So that's a quick example of the types of companies that venture capital attracts. I'm going to move now into another piece of how a shareholder thinks about value creation. And the super important thing here, there's a couple of things actually. Number one, these are my two favorite sayings. The word crisis, for one, represents danger, but also represents opportunity. But the other one is, the best time to plant a tree was 100 years ago. The next best time is today. So in terms of creating value for shareholders, the sooner you can start with testing and learning, and the sooner you can get empirical market feedback from your customer, even if it's selling a fake product or something that has, some sort of a, not complete value proposition, an MVP, if you will, the better you'll learn, the faster you'll get insights from those consumers, and the faster you can start to create value. But value is not created linearly. It is not a slope from left to right. It is much different, actually. Value created is against milestones, and the valuations that companies get when they get an investment are centered around value creating milestones. So if an investment from a seed round investor, at this point, there would be a significant milestone. That milestone could be at the early stages, your first product launch or your first customer announcement. It could be the beta release. There's lots of different ways to shape and determine what those milestones are, but it's specific to each phase that you must have a valid milestone. And what an investor thinks about when they look at this and they think about how value is created, some of the questions that get answered against these milestones happen to be, do the founders know what problems they are solving? Does the product actually work in the marketplace? Will someone actually pay for this product? How many people will pay for this product? As you traverse through these questions that investors have, the value of your business increases. And over time, these questions all get answered. And there's more questions, by the way. How many people will pay? Can a non-founder sell this? Everyone knows founders and startup CEOs have a lot of passion around what they're doing. But the problem of scale in sales in particular, you have to have third-party salespeople be able to sell this. You have to build a sales organization. Can you grow your process at scale? Can you scale without excessive churn? Can you scale profitably? This value milestone sort of stepwise function continues over subsequent rounds of funding, and the risk gets reduced for investors, but the business focus and the motion also changes. And so key milestones to think about as you go through this and you think about what you're going to create for an investor pitch deck: the product concept, the product itself, a functional prototype, early user adoption, early customers, potentially getting other investors on board, profitable unit economics, scalable customer acquisition, profitability of the business, scalable organization, and then ultimately you'll reach an exit and liquidity. But those inflection points are how value is created. It's not just you start on day one and you start creating revenue, and then at the end of day, what at 10,000 you're at the top of the curve. It is really a stepwise function, and investors recognize that. And the best investors will work very closely with you to make sure you've defined the right milestones, and then also that you're providing the right amount of effort and focus around those milestones so that you can get the best results. So that is it for my quick introduction on disruption and value creation, Susan. So I will pause there for any questions.
Well, I'm sure there are tons of questions from the audience. So you guys, you can submit your questions, whether you're watching through YouTube or Facebook or on this Zoom call. Use the chat feature, and I will be fed questions to make sure that JP answers all of the burning concerns you have. But let's start simple. So where do you see the biggest mistakes that entrepreneurs are making at each stage in really articulating how their plans to make value will be? Because a lot of times, if you don't have that traction already, it's not clear. And then those that have a little traction that may be preparing for that Series A, there's different challenges at each phase to make sure that that investors really understand use of funds and where that's going. So could you give us at each stage?
Yeah, I would say that the most important thing, even before you get to the stages of what your value creating milestone is and defining that, the most important thing that a founder needs to understand is that you have to be able to sell two things as a founder and CEO, and it's to two different audiences. Number one, you have to be able to sell your product or your service to your customer. And that is a pitch deck and a set of words and things and marketing statements that you sell to a customer. And then there's a different pitch. You have to sell the company to an investor. And a lot of founders make the mistake of trying to sell the product to the investor or the service to the investor. And they don't spend enough time telling an investor why this company that you're potentially going to give $1 into is going to return $3 to $5 for that $1. They spend so much time talking about how great their product is, how amazing their service might be, or how much they're going to grow, or even worse, they spend so much time talking about future revenue forecasts, 3, 4, 5-year revenue forecasts that are just, as we all know, no model is correct and some are useful. So the real art of pitching for a founder is to be able to have two pitches. You have the product pitch, and then you've hopefully landed some customers, or you're able to really give a strong product pitch, and then you can turn around and say, because the product is so good, here's why my company is so worthy of an investment, and here's how we plan to return your money to you as an investor or create value for you. Then once you've got those two pitches, and that's really two different decks, then you can go into, if you're a seed stage company, what should that value creating milestone be, and what is the realistic length of time, which should be about 18 to 24 months for you to reach that milestone, how much money you'll need to reach it, and where you are in terms of the stage of a company as well. So there's 3 categories that seed investors and early stage investors think about when they look at companies, and that's 0 to 1, 1 to 10, and 10 to 100. And in that genesis phase, in the 0 to 1 customer, 0 to 1 employee company formation stage, the value creating milestones could be product prototype or proof of concept, you're in an R&D phase. If you're moving into the 1 to 10 phase where you're actually hiring employees and you're getting a staff together, you probably have more than one value creating milestone. You probably have a couple of different ones, but they're all related to the specifics of the business and also related to the specifics of the market that you're trying to enter into or attack, and also related to the industry incumbents. I mean, Stitch Fix is a great example. When Stitch Fix went out to attack the big apparel companies and the retail companies, those companies don't think about user engagement. Those companies think about revenue per square foot, because they're retailers and they're looking at 4 walls and how much revenue per square foot I can drive out of those 4 walls. Stitch Fix said, well, that metric is old. The new metric of success in retail is going to be user engagement. And so they started talking about their 2.5 million users that they have. And that's an unusual statement for an apparel company to be talking about users, but that's what it is. And that's what's caused Stitch Fix to be so successful. So you really, it's a little bit of an art and a science, but the most important thing, I think, that the one key takeaway is you develop your product pitch for a customer, develop your investment pitch for an investor, and you're selling the company to an investor, you're selling the product to a customer.
So a bunch of questions are coming in through Facebook and YouTube. So how do you manage the expectations of investors? They need to be excited about the prospects, but how do you keep it realistic? And what does that management look like over time?
Yeah. So to manage, it's difficult. You have to really build a strong, trusted relationship with the investors. And very few investors will abandon you when things go bad if you've been fully above board and disclosing with all of them and developed a very trusted relationship. When things go, investors, so with investors is eliminating information symmetry or any sort of ambiguity or surprise that might come out. And so you can do that through board meetings. I mean, lots of early stage startups have monthly board meetings. You can do that with investor letters. I see it's actually better practice sometimes to send out an investor letter versus a board meeting, because board meetings can take a lot of time and your investors, are doing other things usually. But having open communications, honest about the state of the business, they're not marketing documents. They're not saying everything's great and all of a sudden everything's bad. These are documents or statements that are actually factual of the state of the business, and also making sure that you should not just highlight the wins, but also highlight the worries and the concerns. Because if you start always talking about the good stuff and only talk about bad stuff when it's bad, again, the investor will kind of think, hey, well, wait a minute, why is everything always so good? And then all of a sudden it's bad. So it's really making sure that investment communication, whatever it might be, if it's a letter, has both wins and worries in it.
You can go ahead and shut off the share screen so that we just have that might be easier. Okay, so let's talk about negotiating with investors, justifying and defending valuations and assumptions. I'm sure there's a lot to think about there, but if you can go through, pre-seed, early, Series A, what tools can we use to justify valuations and defend it well?
Yep. Great question, and something that comes up all the time. And the venture capital answer to valuation is your company is only worth what an investor is willing to pay for. So that'll really actually highlight something. If you go to an investor with a predetermined valuation, they're going to actually you could have an adverse reaction to that. A lot of companies negotiate that valuation with the investor to make sure that both sides win, because ultimately, venture capital is about winning together. And it's about setting up a valuation that's not too high that your next round of funding won't be able to reach that valuation or see the right amount of appreciation, and therefore you have a risk. So we have a model that we use in seed stage investing that is a metaphor, but it's basically, if you think about winding up a spring, what you want to do at the seed stage and a lot of people tell you want to take as little money as possible to give you as maximum return as you can. as opposed to later stage when you have a growth stage business where you want to take as much money in as you can to potentially take money off the table. In the early stages, you want the smallest amount of investment that'll get you the maximum return, so that when you use that money and you go through that 18-month period or whatever it might be, and you have your value creating milestone, you can then justify 3, 4, or 5x appreciation in valuation, and that investor is going to reinvest against that increased valuation. So there are a lot of methods that are out there that you can just Google, early stage startup evaluation methods. But some of the ones, the Berkus method is one of the ones that we use a lot. But that puts an actual number on the number of engineering headcount that you have on the company, which is an important factor sometimes in software-driven businesses, because if you're going to sell that business, usually that engineering team gets sold with it. So that's one. In fact, to respond to this question, Susan, I do have a document that probably has about 12 different valuation methods that I'm happy to send to you that you can distribute to the team after this.
That would be great. We can post it to the thread. Perfect.
Yeah, and we'll post that after the call. But again, the coming in, we see it all the time. Coming in with a predisposed, I'm worth this much because I feel like it's worth this much, never works. If you have revenue, there are metrics that you can associate with that. And if you're a growth stage business, you can have a negotiation on that. But if you're a seed stage, pre-revenue company, even if you've invented something terrific, but it's not in market yet, or it's not in market at scale, it's a partnership. So you got to convince the investor to create a fair value with you, and one that's not too big that the next round won't be suitable.
So another question from YouTube. I had traction with my product before the quarantine. Now the MRR is barely growing. It's a startup in the travel industry. Does it make sense to close the startup and try something different, or should I try to keep going?
Yeah, that's a question for your mentor or
Good
advisor.
Question. Challenging.
The impact this has, apparel and consumer goods and retail. But the reality of it is, if you can build a business in one of these segments that has been very impacted by COVID, then once we get through this, hopefully in the next 3, 4, or 5 years, which is potentially the trajectory that this will take to come back to any semblance of normal, your business could stand the chance to have greater gains than other businesses. So I don't know enough about that business to answer the question, but I can tell you now, if someone builds a successful company in travel and hospitality today, that when travel and hospitality is back to where it was, they're going to be very well off.
JP, what are your thoughts on, can investors be coaches or mentors? I guess that's a question of before they invest and after they invest. What are your thoughts?
Yeah, well, it depends on, so sometimes you want to have investors outside and coaches and mentors inside, because and I had a slide I didn't put in here that has like the 10 things that an investor is to or a board member is: fiduciary, responsible to the LPs that are investing, you provide governance, but then you're also a psychiatrist, a friend, a counselor, and et cetera, et cetera. Founders are going through a whole different set of emotions and on this journey that's highs and lows, extremes, highs, extreme lows. So you do need a coach, you do need a mentor. If it happens to be an investor, that's great. The risk though there is that you're going to want someone to cry on their shoulder and potentially, scream and yell at, and you don't want to do that to an investor because they might lose confidence in you. So I'd be very careful in selecting that, but there are early stage seed investors. In fact, there's a group that just launched in New York called the Venture Collective, TVC, that are pre-seed, and Kat, a friend of mine, Catherine, she's one of the principals there, but their whole model is providing help to the pre-seed companies along with the capital. So they come in and they do go-to-market planning, they do sales planning, they do recruiting, they do technical evaluation, product roadmap stuff, they do all that stuff with their investment. So if you can find an investor like that, yes, but if you don't, if your investor is purely financial, then you should get a separate coach or mentor.
So how does a company prepare for due diligence the right way? What are the best ways to make sure that when you go into that due diligence process, you're ready to go?
Yeah, the number one thing is no surprises. Everything that you have told an investor from the beginning has to hold true. Who owns, cap table issues can come up, revenue, issues can come up if you're a revenue producing company. Revenue forecasts, the assumptions are going to be very scrutinized very closely. Customer references are important. Personal references are important. I think again, going back to what I said before about you have to be able to pitch the product from a marketing standpoint to a customer. You have to be able to sell the company and pitch the company from an investment standpoint to an investor. It's also a little bit of marketing. You have to get them excited, but you have to be so honest and truthful about where you are and what you need to get further, and be aware of where those gaps are, because that's what the investor wants to fill. The investor wants to give capital so that you can plug the gaps to get to that next milestone to create value for everyone. Does that answer the question?
It does. And you have incredible Silicon Valley and New York experience, plus having worked with so many companies from all over the world. What are different ways that a Silicon Valley investor may approach the diligence process versus New York versus some of the internationals as well?
Sure. Yeah. Part of that's a challenge for a lot of early stage founders, because in Silicon Valley, you will find a serial entrepreneur can get several $1 million just using a PowerPoint and just basically, being in the right place, the right time, and having the right network. And then on the other hand, you'll have someone who's probably got a viable business that has, actual revenue that goes to an investor, and they get scrutinized all over, raked over the coals for their financial statements and how they're doing. The problem is that investors never diligence everything the same. Silicon Valley investors have certain ways of looking at companies and aligning themselves with companies that they know they can take from A to C value. Other investors prioritize, backwards looking financials to determine if the company is going to perform well in the future, or even worse, trying to overanalyze financial forecasts. So I'll give you an example. There's some red flags. Not all investors are going to be suitable for early stage startups, but if an investor is for a seed company, or certainly a pre-seed company, a seed company, I'd even say a Series A company, if they are over excited about the financial forecast, or they're asking a lot of questions around the financials as opposed to the product and specifically about the team, that can be an issue, because founders will spend a lot of time trying to tune the financials in a certain way for that particular investor. And that's really the wrong question to be asking at that time. Those financial forecasts are not worth that much at that time. It's just too early to have those. So it's a matter of being able to recognize that. But there are, I guess, how to prepare yourself for diligence at the seed and Series A stage. It's really presenting the team front and center. It's really why this team is uniquely qualified to go after this opportunity, why this team can attract A players to join them in this journey, why this team can land customers and service those customers and keep those customers happy. It's really anchored around the team.
So let's talk a little bit about how the entrepreneur should potentially be diligencing the investors as well then. So how do we make sure that we're actually talking to the right people? If it says a certain industry on their webpage, I'm thinking, I may fit their portfolio. What else should entrepreneurs be doing to see if that fit is there?
Yeah, well, certainly looking at the investment thesis or focus that's publicly located on the website, reading about their portfolio companies, but don't be afraid if an investor does have, a lot of founders don't do this because they figure when they get an investor that they're done, that's they've achieved their goal, and sometimes those things go bad because they didn't diligence the investor. So don't be afraid to ask for, can you talk to other company CEOs in their portfolio? Can you talk to other investments that they have that are active or ones that have been exited, to talk to those founders and understand how the journey was with that investor, because it is a long-term marriage. This is not a transactional business development deal or a product sale or even a partnership that's easily unwound. When you land an investor, you have to have trust that they're going to do the right thing for you, that they're potentially financially aligned with your financial goals, that their way of management, whether it's hands off or fully hands on, is something that you want. And there's there's all kinds of those. And so you need to determine if you need the help, then you want a hands-on VC. There's lots of those. I mean, Sequoia Capital is a great one. Inside Venture Partners, lots of them out there. Those are the folks that you'll want to go after, and they all run in small circles. If you want purely financial investment, there's actually other avenues to get just financial capital, but beyond, SBIR loans and other government facilities, municipal grants and things like that, that can help you get more passive investment. But it's really, as a founder, understanding what you need and then getting the financial resources that can get you the most value added capital is my answer to that. So
we have another question coming in through Facebook. Tracking metrics and transparency from an investor's perspective. What are the best practices for founders to make potential investors, to make that review painless? What metrics do you like to see, especially longitudinally? And does that change once you become an investor?
Yeah, in terms of tracking, I mean, you should, as a founder, you should be trying to track every single thing you can. I mean, that just because you don't know what's going to give you insights and intelligence later. So it's important to be data driven as a founder, as a company, and be collecting all the data you can, because ultimately it's asset value for your company anyway. If you know more about your customers or even your employees than some people do. On the transparency side, though, you do need to determine with your investor what that next milestone is that's going to create value for your company. And so if there's a thing called the rule of 40 that I'll share with you that says that if you're growing revenue at 40% in the top line revenue growth, that you have zero on the bottom line, meaning you don't have to make any profit. So you can keep going 40% revenue growth indefinitely. That you keep increasing. By the same token, if you're more than 40%, you can start to lose money. It's what Amazon did famously for a long time. But Amazon was able to do that, Jeff Bezos in particular, because he communicated that very clearly to his investors, Wall Street analysts and hedge funds and mutual funds, saying, we're going to lose money, but our business is about growth. So if you believe in our growth story, then invest in us. So back to what I said originally, when you pitch to investors, you have to pitch the company as an investment. You have to pitch the milestone you're going after that's going to create value, customer acquisition or product launch number one, or whatever it might be. And then you have to give the metrics associated with that milestone in near real time to the investor, because the more the investor sees that you're on track, the better they're going to support you. And the more that they see if you're going off track, the more they're going to come in and try to help you, because they're once they're in for the long haul. So.
Okay, next one. Great answer. My investor wants to put someone on the board who knows nothing about my business. We've had some informal conversations around this, and their mind seems to be made already. How do I approach this conversation? Oh, Dominic, I got a star fruit. Dominic, I'm on a webinar. Sorry. This is the fun of the pandemic. My 8-year-old, our star fruit tree is now up and running. Okay, starting over. My investor wants to put someone on the board who knows nothing about my business. We've had some informal conversations about it, and his mind seems to be made up already. How do you approach this conversation so that you don't end up with somebody on the board that's not going to be value added?
Yep, sure. Great question. And board issues are a huge problem for companies, because in some cases, companies constitute a full board of directors too early. In fact, these days, the best practice at the seed stage is to not have a board. The reason why is because Series A is going to want to probably recast that board, and some people have to drop off, and frankly, it's paperwork and legal expense that is not necessary. So I advise all seed stage companies to keep no board until you have a priced equity round, which is typically your Series A. With respect to the question of having a non-value added board member, in the term sheet with the investor, there should have been a negotiation around governance. And if they want to provide a board seat, or if the board seat was part of that negotiation, then they have the rights to appoint somebody. If that person doesn't add value, it sort of calls into question, why would that investor place that person in there from a governance perspective? But there's also the option, if that person just wants to have, ears in the room so that they can see what's going on, there are board observer roles that can be offered to investors. And there's obviously information rights where they can receive the board reports and the board documents. So I would try to put that investor into a board observer role where they are welcome to be in the boardroom. They're not able to vote, but they are able to be party to all the discussions that are in there, and they can bring that information back to the investor. And that way, if they're not adding value, then they're not actually, physically a board member.
So let's go back. I think that comment you made was great to hear. So many companies are in this rush to create a board, and in reality, those seed local investors may not be appropriate board members and may actually be a turnoff to professional investors later. So let's spend some time on this. When you're building out that advisory group, are we giving them equity? What give us advice at each stage for how we're engaging the right people and making sure we're not turning off later professional investors?
Yeah. So at the seed stage, it is definitely right in front of you to start assembling your advisory board. One of the tasks is to do that, and you should. Advisory board is separate from the board, the board of directors that provides governance for the entity. But on the advisory board side, a common mistake is that startups will overload their advisory board with lots of well-branded names and 4-star generals and scientists and people that seem to be very helpful, but they don't really have a strong relationship with the founding team. And maybe they met them once and they're going to be advisory board. I'd advise you to develop an advisory board of 3 to 5 members that you actually have the cell phone number of and can call them to actually get the advice to move the company forward. And also, those advisors should be compensated with warrants in the company. And the best practice is to allocate about one each get 0.2%.
Wait, JP, we just lost you. We just lost you. So start with the best practice. So they should be given warrants, and the best practice is what?
Yeah, the sort of the rule of thumb, if you will, if you have a 5-person advisory board, they should represent about 1% of the company in warrants. So 0.02% each of those members. And then usually those warrants will vest over a period of time. So 1 or 2 year vesting period, much slower. You don't want 4-year vesting warrants for advisors. And I'll explain the reason why. You want them to vest shorter. So let's say you did, 1 year vesting period. You would have that advisor, advising you for that period of time. They would vest their stock. Then that second year, you would probably go and find a new, if you're being successful and actually growing the company, more advisors to bring on. And some of those other advisors would have, take their equity and kind of fade into the background. You keep refreshing your active advisors by providing, these warrant allocations of about 0.2% each. But you can earmark, a couple percent of your total equity to do this, but you don't want to have a large slate of advisors that are passive. You want to have a small slate of incentivized active advisors. And when they've done their job, they've gotten you to that milestone, you then want to refresh that with a new set and give another set of warrants. And if some want to continue an advisory, that's fine, but let them earn into something and then finish their job and roll off.
So we have a question from Nigeria. Hi, Emmanuel. What strategies would you suggest a startup employ to ensure he has the upper hand in dealings with VCs? That's getting lots of VCs from my perspective. What else?
Yeah, the only way to get the upper hand in a negotiation around an investment into a company is to have something that doesn't need the money. I mean, it's to have revenue, it's to not need the money, it's to recognize that your business is going to succeed without the money, but the money is an accelerant. So if you have a business, if you don't need venture capital because you have revenue, or you have a business that can grow itself and it's just going to take longer, then VCs love that because they can come in and give you that gas to put on the fire. But if you don't have that, if your only source of survival is venture capital, it can be expensive to get it, and sometimes it's not worth the juice isn't worth the squeeze, as they say. Yeah.
Are there standard terms that most people should expect at the negotiating table at the seed stage and at Series A?
Well, these days at the seed stage, I mean, everyone has gravitated to convertible notes and safes. So, the standard terms would be that there's a cap on that convertible note, that there's some sort of a dividend, and there's some sort of a discount to conversion. I mean, those are kind of, and you can Google those, they're pretty much there. At Series A, it's less standard. I would say that there's some non-standard terms that sometimes come up that are red flags that were pretty popular after the dot-com boom, but things like liquidation preferences, where the preferred stock gets paid back a multiple of their investment before the common even gets paid out. Things that will actually eat into your returns as a founder. And there's been stories where founders thought they were going to make a lot of money, and lo and behold, when it all unwound after the exit, because of layers of preferred and all these liquidation preferences kicked in, there was very little left for the common shareholder. And by the way, it's not just founders, angel investors also typically get caught off guard by some of these things. So, I'd say I'd watch out for like liquidation preferences and some more aggressive terms, but there's not really a standard for Series A. It's really about the company and what the company needs.
Okay, a bunch of questions came in around funding syndicate type thing. So in leading financing round, what are the challenges of finding a lead investor? How do you manage finding a lead investor? And why do so many people expect there to be a lead and then kind of other people who come to the table? Can you walk us through that?
Yep. And probably a lot of people say that when they say, well, I've got some money that people are interested, but I don't have a lead, and you're looking for the lead investor. Lead investor takes on a very active role. They set the terms for the round. They provide and lead the confirm. On the hook for the board.
JP, we have to start all over. Sorry, your internet's really bad. So you said they set so lead investors, what's the lead investor's role?
Yeah, the lead investor sets the terms and then provides all of the frameworks for the governance. And so board seats, how the company is going to report out to its investors, how it's going to be viewed from a passive or active investor standpoint, depending on how hands-on or how hands-off they are. All of those things get defined by the lead investor. And then that lead investor also usually, in Series A and beyond, then takes that board seat and provides, governance and the reporting back out to the other members of the syndicate. It's a lot of work. You need an investment professional to lead a company through, a 30 to 90-day process of confirmatory diligence and the closing of the round and all that. And that lead investor takes on that role. So, and there's expenses associated with it. There's expenses put back to the company. There's time and legal expenses. And so, when you have a syndicate, not everybody wants to do that, and not everybody is even qualified to do that. So, the whole thing about finding a lead investor is aligning with someone who understands your business, can add that value, but then also that lead investor usually is going to be around for multiple rounds. So that syndicate that's been assembled for this round may change over the next 2 or 3 rounds. The lead investor should have, what's called the dry powder, or, the investment, ability to continue to invest in your next round and then your next round of funding after that. So if you don't have an investor that's going to be along for 3 rounds, then you don't have a lead investor.
So investors that co-invest with others, does it change the negotiation assumptions? How does that work?
Usually the investors will all get aligned themselves. So there's not, you're negotiating. When you're negotiating with a syndicate, you're still negotiating with one group. It's a collective of investors, but it's still, you're not going to have any preferential terms. There are exceptions to that. There are, some things that can be done differently, but by and large, the syndicate, the lead investor speaks for the syndicate of co-investors, and usually that's the person who runs the process of confirmatory diligence and then closing of the investment round. Yep.
After receiving investment, what other types of personal involvement will or should be expected from the investors?
Right. Yeah. So that's really, that should come out during the discussions around the company and how and what you need to get to that next milestone. So, some companies need a lot of resources around go-to-market planning and customer introductions. Some companies need a lot of time and help with recruiting and talent acquisition. Some companies don't need product help. It really depends on what you're going to get that money for. That investor should be able to provide resources to help you do that, or at least be able to point you in the right direction to get that. There's very few venture capitalists these days that are purely financial investors. That's really left to more private equity. Even private equity is more hands-on. But most VCs these days have platforms that they have associated with their firms, and those platforms provide legal, marketing, recruiting, all kinds of services for the portfolio companies. So.
How can a company that's bootstrapped for years attract investment when it looks like they're at a later stage?
Well, that's a good thing. If you're late, if you've been bootstrapped for years and you have a very clean cap table, meaning you haven't, I've seen companies that have been bootstrapped for years by taking on angel investments, and you have 30, 40, 50 angel investors in a company, and that's really difficult to deal with. On the other hand, if the company's been bootstrapped by personal founder or by revenue, by customer bootstrapping, which is the best bootstrapping of all, then it's a matter of just telling a story about how you think you can scale that business and how an investment of X number of dollars is going to result in this this output. I forgot to mention one thing earlier, Susan. I think it's super important when a founder is going to pitch an investor for an institutional investment. They need to know the exact amount of dollars. $2.5 million.
Wait, we have to start all over.
You almost need to get down to
JP, we lost you. So start again at it's really important when an entrepreneur is pitching to know the exact amount. Go ahead.
Yeah, to know as close as possible to the exact amount you need to get to that next milestone. Not down to the decimal point, but down to 1.5 million, not 2 to 4 million, right?
Yeah.
Because you have to get real specific with that use of proceeds, and the more specific, the better. And then also going back to what I said before, raise as little as possible to get the maximum result. Don't raise as much as you can, because that will set humongous expectations later on, that if you have one mistake, if you're a revenue producing company and you take on too much capital and you don't scale your revenue fast enough, you're not going to be able to attract more capital. And then you're going to get caught in a very weird spot where your investors want more output, but you don't have the resources to do that. Then you have to go figure out how to finance that. Then they might not want to put in more money, or if they do, it might be on worse terms, better terms for them, worse terms for you. It gets really, really sideways very quickly.
Do you have time for one more?
Yeah, of course.
Great. Okay. So I want your thoughts on small team, growing a company together, smaller teams who are a bunch of founders or shareholders working for equity. How do you figure out the right mix of who gets what? There's that slicing the pie method that a lot of people use, that we actually use with a lot of our companies. But what's the right fit when you're co-founders or a founder with some team members? How do you start figuring out who's worth what?
Yeah, great question. And I just went through this with a company that I'm advising up in Cambridge, Massachusetts on this exact same thing. And just yesterday, I got a message from the founder saying the corporate documents are done, but I helped coach them through this exact thing. The founders, the people who are 100% dedicated to the business, whether they're drawing a salary or not, are going to get founder shares. Then you need to determine, so those people, let's just say first of all, you don't want too many of those. If you 3, 4, max 5-ish, if you get it, but really, 2, 3, 4 is where you want to stay in that range. If those individuals are able to take 0 salary, they should get a bigger piece of the equity. If they need salary, which many people do, obviously, then there's a trade-off in that equity. And you really, as founders, need to have your own discussions amongst yourselves on what your trade-off between salary and equity is going to be, because that same thing will hold true when you get the subsequent investment rounds. Is the people who are earning more sweat equity by taking less salary are going to get more equity compensation. Those people should split up the initial pie. Then they should have reserved out of that initial pie about 20% of the company for their seed round raise and or the bringing on of seasoned executives in a particular role if that investor wants or determines that that's needed. And so those roles could be an experienced CEO, that could be an experienced CTO, it could be a head of sales, it could be chief revenue officer, any chief of anything. They're going to be worth 1 to 5% of the company. And so you really have to model out your organizational design, from the founders down to that first layer of management, because you have to have the equity capital to incentivize and recruit the key leaders there. So if you didn't reserve enough, if you just took the pie and said, 4 of us 25% each, and then you went out to go raise funding, you're going to have to redo all of the allocations. So you really need to carve out 20 to 30% of the company for key hires, and then for the first round of funding. So
awesome. Well, I can't thank you enough for always just giving us the real deal. No hard. I can't thank you enough for finding the time as well. Hopefully we'll have you back in the coming weeks. And if you're lucky and you did all of your work and got in on time, you might end up with JP as your mentor in August for the Accelerate 2 component. So thank you again for finding the time. JP, always lovely to see you. And we'll see you guys next week. Next week, we have Jim McKelvey, the co-founder of Square, talking about disruption and innovation. And I think it'll be really fascinating. So hope you can join us for that, guys. Bye. Have a great one. Thanks.
Thank you.